This wasn't speculation. This was a structural unlock. A God candle doesn't appear on silver charts because of sentiment or retail excitement. It appears because something in the settlement architecture just shifted, and when that happens, the price doesn't ask permission. It moves. The title promises a path from $100 to 530 days, and that sounds like hype until you understand what a God candle actually signals in the commodity space. It's not a prediction, it's a confirmation that liquidity just reorganized, that derivative positions just got squeezed into a corner, and that the next 4 weeks will force a reprice whether the market wants it or not. In the next few minutes, I'll show you 3 things. What changed in the silver market structure that made this candle possible? Why it changed now, and not 6 months ago or 6 months from now? And what it forces next, not just for silver, but for the entire precious metals complex and the currency scaffolding that sits beneath it. Let's start with the public story versus the private move. Headlines will tell you silver rallied because of inflation fears or industrial demand or some vague geopolitical tension. That's the surface. The private move is different. The private move is about settlement windows, about the timing of contract rollovers, about the exact moment when open interest hit a threshold that couldn't be absorbed by the dealer network without triggering a cascade. That detail changes the interpretation. This wasn't a rally driven by buyers. This was a rally driven by forced covering by institutions that were short and suddenly had no liquidity cushion to manage the exit. The mechanism here is precise. Silver trades in 2 worlds: the paper world, where futures contracts and options create synthetic exposure, and the physical world, where actual metal has to move, be stored, be delivered. Most of the time, these 2 worlds stay separated by a thin layer of dealer inventory and cash settlement preferences. But when that layer compresses, when the gap between paper claims and physical availability narrows past a certain point, the price doesn't drift higher. It snaps. The lever that just activated is called the deliverable stockpile ratio. It's not a term you'll hear on financial television, but it governs everything. It measures how many outstanding contracts are theoretically eligible for physical delivery against how much registered silver actually sits in approved warehouses. When that ratio climbs above a certain threshold, the market enters a different regime. Shorts can't simply roll forward and hope for time. They have to make a decision: deliver metal, buy it at market to deliver, or close the position at a loss. That decision point is what created the God candle. Now let's walk the timeline ladder, because this didn't happen in a vacuum. First, registered silver inventories at COMEX warehouses began declining in the 4th quarter of last year. Not sharply, but steadily. Every week, a few million ounces moved from registered to eligible status, which means it was no longer available for delivery against futures contracts. Then, open interest in the front-month contracts started climbing in early January. That's unusual. Normally, open interest declines as expiration approaches, because most participants close or roll their positions. This time it grew. That tells you someone was adding exposure, or someone was trapped and couldn't get out. Third, the January contract expiration passed with an abnormally high delivery rate. More contracts stood for delivery than the market expected, which drained another chunk of registered inventory and tightened the stockpile ratio further. But that's not the real pressure point. The real pressure point showed up 2 weeks ago, when the March contract, the next major expiration, saw a sudden surge in volume and a widening of the bid-ask spread during off-hours trading. That spread widening is a tell. It means liquidity providers were stepping back, unwilling to take the other side of trades without a larger cushion. When dealers step back, volatility compresses into a smaller market structure, and that's when candles turn vertical. Fifth, a series of large block trades appeared in the options market, specifically in out-of-the-money calls with March and April expirations. These weren't retail trades. The size and timing suggest institutional repositioning, either to hedge short exposure or to front-run a move they saw coming. And sixth, the God candle itself, a single session where silver moved more than 6% intraday, with volume 3 times the 10-day average, and with almost no retracement during the session. That's the hinge point. That's the signal that the market structure just shifted from managed to reactive. Here's where the incentives show up. Who benefits? The entities that were long physical silver or long futures going into this move. That includes certain hedge funds, commodity trading advisors, and importantly, sovereign buyers who've been accumulating metal quietly for the past 18 months. Who gets boxed in? The short side, which in the silver market is historically dominated by a handful of large banks and dealers who use short positions to manage client flow and hedge their book. When the price moves this fast, those hedges become liabilities and the exit is expensive. What gets hidden? The off-exchange transactions. When the paper market dislocates like this, physical metal starts changing hands outside the official reporting channels. Private vaults, bilateral deals, settlement in kind, that activity doesn't show up in the data until weeks later, and by then the price has already moved. Understanding who benefits, who gets trapped, and what gets hidden is how you separate noise from signal. The noise is the headline volatility. The signal is the incentive structure that's now locked in for the next 4 weeks. What this breaks next operates on 3 levels, and each level carries a trigger that's already armed. If registered silver inventory falls below 8,000 tons, and it's currently at 9,200, then the entire COMEX delivery system enters what traders call a stress test mode. That's not a formal designation, it's a behavioral shift. When stockpiles get that low, every large position holder starts calculating whether they can actually be made whole in physical metal, and that calculation changes how they trade. The moment that doubt enters the system, the paper price loses its anchoring function. It stops being a reference point and starts being a lagging indicator. The second consequence is in the options market. If silver sustains a move above $32 for more than 5 trading sessions, the gamma exposure on short-dated call options forces dealers to hedge dynamically by buying futures. That buying creates a feedback loop. Higher futures prices increase the delta on even more out-of-the-money calls, which requires more hedging, which pushes prices higher still. This isn't theory, it's mechanical. The math is fixed. And when that loop starts, it doesn't stop until implied volatility collapses or the price moves far enough to exhaust the gamma stack. Right now, implied volatility is rising, not falling, which means the loop has room to run. The third breakpoint is in the mining equity space. If spot silver rises faster than the discount rate applied to future mining cash flows, the equities lag. But when spot silver breaks a multi-year resistance level, which it just did, the equities eventually catch up in a compressed window. That catch-up phase historically happens over 2 to 4 weeks, and it typically overshoots by 15 to 25% relative to the spot move. That overshoot is where the 100 to 500 calculation comes from. It's not about silver itself. It's about leveraged exposure to silver through small and mid-cap miners that are suddenly repricing their entire asset base. Let's translate that into the 3 buckets. If you hold cash, you're watching purchasing power erode against hard assets in real time. But more importantly, you're watching the opportunity cost expand. Cash sitting in money market funds returns 5% annualized. Silver just moved 6% in a single session. The divergence is geometric, not linear. The longer you wait, the more expensive the entry becomes, and the less metal you can acquire per dollar deployed. That's not a pitch, that's arithmetic. If you hold risk assets, equities, corporate credit, real estate, you're now facing a different kind of pressure. Precious metals moving vertically usually signals a repricing of monetary risk or a liquidity event somewhere in the system. It's a warning flag. When silver and gold move in tandem and with volume, the message is that institutional players are shifting into tangible assets because they see something in the forward curve or the credit market that hasn't surfaced in the headlines yet. Your risk assets aren't necessarily in danger, but the correlation structure just changed. What was diversified last month isn't diversified this month. If you rely on a paycheck, the translation is simpler but harder. Your income is denominated in currency. Your expenses are increasingly denominated in commodity-linked goods: energy, food, materials. When silver moves like this, it's a proxy for the entire commodity complex beginning to reprice. That repricing flows through to consumer prices with a 3 to 6 month lag. The move you're seeing now in silver is the move you'll see in your grocery bill in the second quarter. That's the second order effect no one explains in the headlines. But let's rehook for a moment, because the God candle itself is just the visible part. The real story is what happens in the 30 days after a God candle appears and why that window is so compressed. The 5-rule playbook for this phase is specific, and it's not based on prediction, it's based on how market structure behaves under strain. Rule 1, don't chase the God candle itself. The vertical move already happened. The entities that captured that move were positioned before it started. What you're tracking now is the digestion phase, the pullback, and the secondary move that confirms whether this was a one-time squeeze or the beginning of a sustained leg higher. Rule 2, track the registered inventory data weekly. COMEX publishes this every Friday. If inventory continues declining, the squeeze thesis remains intact. If it stabilizes or rises, the pressure valve just opened and the move is likely exhausted. Rule 3. Assume the mining equities lag reality by 1 to 2 weeks. The spot move happens first, the equities reprice second. If you're looking at leverage, the entry point isn't day 1 of the God candle. It's days 5 through 10, after the initial euphoria fades and before the institutional flows arrive. Rule 4. Treat the gold-silver ratio as the signal, not the headline price. Silver at $32 sounds expensive if you anchor to where it was 6 months ago, but if gold is at $2,700 and the ratio is 84 to 1, silver is still historically cheap relative to gold. The ratio is the tell. When it drops below 80, the catch-up trade accelerates. Rule 5, keep optionality. This environment rewards the ability to move quickly, to deploy capital when confirmation arrives, and to exit when the structure changes. Illiquid positions, complex structured products, anything that takes more than one session to unwind, those are vulnerabilities now, not features. The incentives that drove the God candle are still active, and they're not subtle. The short side is now in damage control. Every tick higher increases their loss and reduces their maneuverability. They can't simply add to the short position to average down, because inventory constraints mean they might actually have to deliver, and delivering requires buying physical metal at market, which pushes the price higher and worsens the position. That's a trap, and it's visible in the order flow. Large block offers that would normally cap a rally are absent. The selling pressure that would typically show up after a 6% move isn't materializing. That absence is information. It tells you the short side is either out of ammunition or deliberately staying out of the way to avoid triggering another spike. On the long side, the entities that initiated the squeeze are now managing a different problem. They won, the position is profitable, but if they try to exit too quickly, they collapse the very move they created. So they're distributing slowly, selling into strength, taking profit in pieces, while maintaining enough of a position to keep the pressure on the shorts. This is a chess match playing out in microseconds across electronic order books, but the strategy is ancient. Control the tempo, force the opponent to move first, extract maximum value before the structure resets. What gets hidden during this phase is the physical accumulation by non-Western central banks and sovereign wealth entities. They don't report their purchases in real time. The data shows up in import-export statistics 3 to 6 months later, but the flow is happening now. When paper prices dislocate from physical availability, the buyers with the longest time horizon and the deepest pockets step in and acquire metal at scale. They're not trading, they're accumulating. And that accumulation removes supply from the market permanently, which tightens the stockpile ratio further and sets up the next leg. The timeline for the 100 to 500 move is predicated on this structure holding for 30 days. That's not random. 30 days is two options expiration cycles. It's the window in which open interest has to be resolved, in which the March contract positions have to be closed or rolled, and in which the gamma exposure on the option stack reaches maximum impact. If the structure holds, if inventory keeps declining, if the shorts can't regain control, if the physical buyers keep absorbing supply, then the mining equities reprice in a condensed window. A stock trading at $2 with a net asset value of $4 doesn't stay at $2 when the underlying commodity breaks out. It moves to $3.50 or $4 or higher, and it makes that move in days, not months. That's the leverage. That's where the multiple comes from. The God candle was the ignition. The next 30 days are the acceleration phase. The forward curve in silver futures just inverted between the March and May contracts, and that inversion is a tell that doesn't show up in the headlines but governs everything that happens next. When the near-term contract trades at a premium to the deferred contract, it signals immediate demand that can't wait. It signals tightness in the physical market that the paper market has to respect. And it signals that the entities holding metal have no incentive to sell it forward, because they believe the spot price will be higher in 8 weeks than it is today. That belief, when it's reflected in the futures curve, becomes a self-fulfilling mechanism. Traders see the inversion, recognize the signal, and position accordingly. The inversion feeds on itself until either new supply arrives or demand exhausts. Right now, new supply isn't arriving. Mine production schedules are fixed quarters in advance. Recycling flows are minimal because consumer holders of silver, jewelry, bullion, industrial scrap don't sell into strength anymore. They learned from previous cycles that selling early means missing the top, so they wait. And that waiting removes the natural cap that would normally limit a parabolic move. The second order effect of the inversion is in the financing market. Entities that are short silver futures have to pay to maintain that position when the curve inverts. It's called the carry cost, and it bleeds capital every single day the position stays open. That bleeding creates a time pressure. The longer the inversion persists, the more expensive it becomes to stay short, and the more attractive it becomes to simply close the position and accept the loss. This is how squeezes extend beyond the initial spike. The God candle was the first move. The inversion is the mechanism that sustains the pressure for weeks, not days. Now let's address the elephant in the room, the idea that this is just another false breakout, another head fake that traps late buyers before collapsing. That's a reasonable concern, and the data answers it directly. False breakouts in silver typically occur on low volume, with minimal change in open interest, and with immediate mean reversion within 48 hours. This move had triple average volume, a surge in open interest, and 5 consecutive sessions of higher lows. The technical structure is different. More importantly, the macro backdrop is different. Previous false breakouts happened in environments where central bank liquidity was expanding, where credit was easy, where the incentive was to chase yield in risk assets rather than hide in hard assets. That's not the environment now. Liquidity is contracting. Credit spreads are widening. The yield curve is sending recession signals even as inflation remains elevated. That's stagflation architecture, and in stagflation regimes, commodities, especially monetary commodities like silver and gold, don't mean revert, they trend. The correlation structure confirms this. Silver's 30-day correlation with equities just went negative. That's rare. Normally, silver trades with a positive correlation to risk assets because of its industrial demand component. When that correlation flips negative, it means the monetary demand component is overwhelming the industrial component. It means buyers are treating silver as a hedge, not as a growth play. And hedges don't get sold when volatility rises. They get accumulated. Let's dig into the mining equity math, because this is where the 100 to 500 thesis lives or dies. A mid-tier silver miner produces, on average, 8 million ounces annually. At $25 per ounce, that's $200 million in revenue. At $32 per ounce, that's $256 million. But the cost structure doesn't scale linearly. All-in sustaining costs are largely fixed. Labor, energy, equipment leases, permitting. Those costs don't rise just because silver rises. So the incremental revenue from a $7 move in silver drops almost entirely to the bottom line. A company that was marginally profitable at $25 becomes highly profitable at $32. The equity market reprices that shift with a multiplier, typically 8 to 12 times forward earnings for mid-cap miners. A stock trading at $2 with earnings per share of 10 cents is priced at a 20 multiple, which is high for a commodity producer. But when earnings jump to 30 cents per share because of a sustained move in silver, the stock doesn't stay at $2. It reprices to 3 to 4 to 5, depending on how long the commodity price holds and how much the market believes in the sustainability of the new margin structure. That's where the leverage comes from. The spot move in silver is 6%. The equity move can be 50, 80, 100% because the earnings multiplier effect is geometric. And it compresses into a short window because institutional capital doesn't trickle into small cap miners. It floods in once the thesis confirms. The confirmation happens when silver holds above 30 for 2 full weeks and when the first quarterly earnings report reflects the new price deck. That earnings report comes in late April, which means the window to position ahead of that report is the next 30 days. But there's a trap here, and it's important to name it. Not all miners are equal. Some have hedged their production forward, which means they sold future ounces at lower prices to lock in cash flow certainty. Those companies don't benefit from the spot price rise. They're locked into the hedge price until the contracts roll off. Other miners are in jurisdictions with unstable regulatory environments where a sudden windfall in profitability triggers resource nationalism, governments renegotiating royalty rates, imposing export controls, or outright seizing assets. Those risks don't show up in a stock screener. They show up in the fine print of the annual report and in the geopolitical risk premium that institutional buyers apply when they model the position. The miners that benefit most from this move are the ones with unhedged production, stable jurisdiction, low-cost structure, and a development pipeline that can scale into higher prices without massive capex. That's a narrow filter. It eliminates 80% of the names that show up in a basic silver miner search. But the 20% that pass the filter are the ones that deliver the asymmetric return because they combine operational leverage with balance sheet safety. The market pays a premium for that combination once the thesis is confirmed. Right now, the market hasn't priced it in yet. The lag is the opportunity. The unanswered question is whether this move in silver is the leading edge of a broader commodity supercycle or whether it's an isolated squeeze that resolves in 6 weeks and leaves everyone who chased it underwater. The answer depends on one thing: whether the physical market stays tight. If registered inventory stabilizes, if new supply shows up from unexpected sources, if the shorts find a way to deliver metal without spiking the price further, then this is a squeeze and nothing more. The God candle becomes a monument to a trade that worked for the early movers and trapped everyone else. But if inventory keeps falling, if the deliverable stockpile ratio keeps climbing, if the inversion in the futures curve persists, then this isn't a squeeze, it's the beginning of a structural repricing. And structural repricings don't end in 30 days. They run for quarters, sometimes years, and they reset the entire valuation framework for the asset class. The data over the next 2 weeks will tell you which path you're on. The registered inventory report this Friday is the first checkpoint. The March contract expiration in 3 weeks is the second. The mining equity volume and institutional flow data in between is the third. If all three confirm the tight supply thesis, then the 100 to 500 move isn't speculation. It's pattern recognition applied to a structure that's already in motion. The God candle didn't ask for permission. It signaled that the rules just changed. The next 30 days determine whether the market respects that signal or tries to fight it. And in commodity markets, when the structure breaks, fighting it is expensive. The smart money doesn't fight. It flows with the break until the structure rebuilds. That rebuilding hasn't started yet, which means the move has room. The window is open, the clock is running.